I want to thank everybody out there in the audience as well. Appreciate your time today, and I am very excited that we're able to talk about crowdfunding, especially since right now we are at the edge of a tipping point, one of those great strategic inflection points where if you think this thing is big now, you might have heard about Kickstarter online, the Pebble Watch, raising $10 million for an app-enabled watch. Wait till you see what happens in 2013 as we get into the phase of equity-based crowdfunding, where you can actually get an ownership stake in exchange for your money. So thought we'd talk a little bit today about just where crowdfunding sits, where it came from, where it's going, and how you could take advantage of it, whether you're an individual, an organization, entrepreneur, startup, and use it to launch any project, product, or brand, or business for that matter. So let's dive right in. So right away, I thought it might be good to take a look at a quote from Eric Mijikovsky. He's the creator of the Pebble Watch, one of the most biggest successes that we've seen in crowdfunding to date. And he talks about how crowdfunding represents a fundamental change in the way that businesses, technologies, entrepreneurs are evaluated. And I think it's an important distinction to make here, because if you notice that he's talking about entrepreneurs being evaluated, it's not just the business plan. It's not just the actual product, but people are looking to make a connection with you. You need to build trust. You need to build empathy, because at the end of the day, crowdfunding is largely a social movement in nature, and it's almost more of a marketing-based effort than it is a traditional fundraising. So ultimately, at the end of the day, you need to convince people that you are the right people, the right team, the right person, the right product, the right brand to entrust with their money, and that you're going to be able to pull this off. So when we talk about crowdfunding, it's interesting that a lot of people think about Kickstarter, Indiegogo, Rocket Hub, a lot of the traditional services where you get rewards in exchange for your pledges. And for those of you who are new to crowdfunding, maybe just do a brief overview. Essentially, crowdfunding is where you post a pitch online, could be for a product, could be for a business, could be for a brand, could even be for a creative or entrepreneurial idea, maybe even a fundraising project you have in mind, philanthropic. And then you ask the everyday public to donate, or I should say contribute, because it's not a charity-based effort in most cases, although we do have those types of crowdfunding sites, typically in exchange for rewards. Could be $10 gets you a copy of a musician's CD, $25 gets you a collector's edition, $500 gets you a thank you in the liner notes of the album, and $5,000 gives you a chance to jam on stage with the band. But as I was saying, there are different flavors of crowdfunding, reward-based being just one of them. So you also have donation-based, which is where you give out of the generosity of your heart. You also have lending-based, where you lend an entrepreneur or business your money, and they give you a favorable rate of interest as a return. But there's also equity-based crowdfunding, and this enters the picture in 2013. So again, we're right here on the tipping point. And by that, what I mean is right now, you can do this in Europe, but equity-based, you're going to be able to get a piece of the business, potential chunk of the profits for the dollars that you put into it. And crowdfunding is even becoming so ingrained that we now have what we call white label solutions up here. And by that, what I mean, you have software plug-and-play backends like Launched, Launcht, where if you wanted to form a crowdfunding site, you could simply insert their software and put a front-end wrap or some graphics on it, brand it as you will, and you'd be good to go. So where did crowdfunding come from? Well, the internet's memory, surprise, surprise, is a little bit hazy, so take it all with a grain of salt. But one of the earliest known examples we see up here is with a British rock band named Marillion. Now, around about 1997, their fans would like them to come tour the US. Just one problem, at that point I guess the dollar was a little stronger, they didn't have enough money to do it. So without telling the band, fans on online news groups actually started to raise money for the tour. And eventually Marillion finds out, they say, all right, well, we'll give a CD of live performances to everybody who donates to the campaign. And guess what? Band raises $60,000 online and actually creates such a profitable channel dealing direct with their fans that they're able to start launching their own albums. They effectively become a self-publisher thanks to that one-to-one connection. So crowdfunding deeply rooted in the music business. You can see around the turn of the millennium, services like Artist Share up there launched, which allowed you to donate to your favorite musicians in exchange for exclusive access to songs, videos, performances, other pieces of material. And this evolves towards the back half of the latter decade. You see sites like Celeban, Kickstarter, Indiegogo, others begin to emerge, many of which weren't successful out of the gate and actually had to retool their model somewhat before they took off. And so in the last couple years, crowdfunding's really come to the forefront as access to capital through traditional sources, banks, venture capital firms. It's been harder to come by for small businesses. And of course, as grants, other scientific boons have been harder to gain access to, crowdfunding, people turn to the internet, and they're turning to these new channels for just about every effort under the sun. And the reason that I have all these logos down here is I wanted to illustrate that the future of crowdfunding really lies in a variety of niches. So if you think about all these types of services, some are dedicated to technology startups, some are dedicated to consumer products, others are going to be dedicated to real estate, film, the arts. They're all going to have to coexist. If you think about them like siblings, they may not always play well together, but they're all going to coexist in the same house, along with traditional rewards-based crowdfunding as well. So you're going to see an explosion in platforms and interest in the space in the next year. So just to paint a picture, how big is crowdfunding today? Well, it's a $1.5 billion that we see that was raised in 2011. So pretty good chunk of change, especially from a small business perspective, although I think Will and others would note that it's a small drop in the bucket compared to overall investment. But more important to note, $2.8 billion expected to be raised in 2012, so nearly doubles. This is not a trend. This is not a fad. This is not going away. This is the future of investment, and it's beautiful because it actually democratizes the investment model. And you can see this reflected in 1 million campaigns funded in 2011, many of which were created by people who wouldn't consider themselves entrepreneurs or business owners. You even see children able to raise funds for charitable efforts or new products or projects online. So really what we're talking about is the chance to create opportunity, especially for people who don't happen to have very wealthy or influential friends. In the past, a very small select group of angels, VCs, would determine what they felt the public wanted. They would fund the projects, the products that they felt people would be most interested in, and effectively tried to make taste for the general public. Now suddenly the public can decide for itself and vote with its wallet. And actually what's interesting, most people when we talk about crowdfunding think about these reward-based platforms, Kickstarter, Indiegogo, and such. But really, equity-based crowdfunding is the fastest growing at the moment. And you can see that over 80% of projects on equity-based crowdfunding sites have raised over $25,000. So not too shabby. Actually, 63% compound annual growth rate for the industry over the last 3 years. In other words, it's skyrocketing. So Kickstarter, which is the largest site currently operating in the space, at least from the reward-based perspective, allows you to see some of the stats online. They have a page, so you can look this up online. I went the other day just to take a peek, to put things in perspective. And you can see that of the total dollars raised, you can see that the successful dollars, the ratio there to unsuccessful dollars, outweighs it by nearly 9 to 1. So people are doing this, and they're doing this very successfully to the point that nearly 44% of projects are successfully funded. Okay? They have greater success on Kickstarter than you do with marriages in California. I looked up that stat online, although from the Real Housewives of OC, if anybody watched that show, if anybody's seen that, you may realize that higher sums of money appear to be at stake. But if you look further, now I don't want to paint too rosy a picture, because crowdfunding is not a silver bullet. It's not magically going to transform the shape of small business funding overnight. You have to be realistic about it, because if you look closer at the stats, you can see that although there's 31,000 projects here that have been successfully funded, the number that have raised above $100,000 appears to be about 1%. And you have to forgive me, I'm not great with math. I know that we've got some professors in the audience, so anybody wants to correct me, by all means speak up. But it's a much smaller ratio. So we have to be very conservative here, and we have to understand the majority of funds raised are in the $1,000 to $100,000 range. But again, like I was saying, crowdfunding is exploding. It's one of the hottest new forms of business investment. And you can see this reflected in the number of platforms or crowdfunding sites there are worldwide. Literally over 525 active today. You can see these on crowdsourcing.org. And this is before all that money comes in, when you can get a piece of the profits. So it's going to get bigger. 300% growth in equity-based crowdfunding and reward-based crowdfunding. It's going through the roof. And although lending and donation-based crowdfunding is lagging somewhat behind, you can see between 75%, 50% growth rate here, we're not doing too shabby. So just to illustrate the opportunity that exists for businesses in this country, Our friends at crowdfunder.com put together a nice little infographic. $300 billion is what they peg the opportunity at for the business crowdfunding market. And there's a great quote here from the author of Lovecasting who says that basically if Americans took 1% of the $30 trillion that they held in long-term investments and they were to pour that back into small businesses, it would represent literally more than 10 times as much venture capital was invested in them in 2011. Now, this serves as an engine for growth. It helps create jobs. It helps drive the strategic innovation this country needs to remain at the forefront of the global economy. And you can see these graphics at the bottom really paint a picture of what's going on today, and that access to capital is largely frozen. It's very hard to get a loan from the bank. It's also very hard to convince small business operators and VCs to be able to connect, get on the same page, because ultimately, at the end of the day, the scale isn't quite where it needs to be for a traditional investment firm to be there. And so by crowdfunding, by offering rewards, by offering equity, by offering something that everyday members of the general public can connect with, you can actually raise those funds, get those dollars flowing, and as the crowdfunding exemptions come to pass in the halls of government, you can see how it enables opportunity for small businesses and businesses, in fact, of any size in this country. So it's absolutely one of many ways forward, but it's definitely one of the most promising ones. The Jobs Act, major milestone in the crowdfunding movement, because what the Jobs Act does is it enables businesses to raise funds online through crowdfunding through the sale of equity. And we call it Angel Investment Reimagined. In a 12-month period, you're going to be able to invest quite a large sum in any of these businesses from an individual perspective, that is. And what it says is businesses can raise $1 million up to online through crowdfunding of equity. And individuals, if you want to invest, up to 2% of your net worth or annual income if you make less than $100,000. So $2,000 cap in any 12-month period if you decide you want to invest. Now, if your net worth or your annual income happens to be above $100,000, then what the Jobs Act allows you to do is invest up to 10% of that, up to a $100,000 cap, into the business. And of course, this all has to be done through SEC-approved funding portals. Now, you'll note the catch there. Although you can do this in some cases in Europe, in certain territories, here in the States, it's not yet legal. The SEC has until early 2013 to weigh in, to provide some rules and regulations, and that's how you're going to begin to see approved crowdfunding portals get out there on the scene. But the important takeaway here, I think even more important, is that the dam is about to burst. If you think interest in crowdfunding is cresting now, wait until you see the tidal wave of interest that happens in 2013 and 2014 as a flood of new crowdfunding sites, I call them platforms here, and business models or processes starts to hit the scene. So what can funding portals do? I think it's important here just to talk a little bit about what the opportunities are. Now, funding portals cannot give investment advice or recommendations. Technically, they cannot solicit you. They cannot push you towards specific crowdfunding projects over any others. And what they can't do is pay out a commission based on incentivizing employees to sell you certain crowdfunding projects or investing in them. And of course, they have to disclose risks. They have to let you know what the opportunity costs are, some of the concerns are around some of these projects. They have to provide review materials, perform background checks on officers, directors, anybody who holds more than a 20% stake in the company. And of course, they don't pay out until initial funding targets are raised. So when companies go online to raise equity, they say, we want to get X amount of dollars. Could be 100K, 500K. But investors have to be allowed to back out, and they do not pay out until the total funds are raised. So crowdfunding, I thought we'd talk a little bit here about its upsides and its downsides as well, because again, crowdfunding is not the perfect solution. It's not right for every business or every venture, but it can be a very powerful tool in the right hands with the right opportunity. Now, some of the pluses from an entrepreneurial perspective is that it lets you gauge public demand from day one and right-size your operations, your production, because essentially, if you think about it, even the world's biggest businesses and brands and its most successful entrepreneurs, all they can do is make educated guesses, even in the best of scenarios. How much will people buy? Will they be willing to buy it? How should we package and present it? What should we price it at? You'll find out very quickly online. And the nice part about it is you're bringing cash in the door from day one. So all those pledges, all those contributions are allowing you to take less upfront risk. You're minimizing your spend. Typically, I would have to build an extensive prototype, ship it out there, and only sell it once the product was done. And now we can actually be taking what are effectively pre-orders right from day one, helping to build buzz, helping to build awareness, and helping to create a following for this product. And the nice part about it, you engage and activate consumers. They're out there, they're talking about it, they're spreading that awareness, they're becoming brand evangelists. And of course, on the flip side, they're also the best focus group that money can buy, because the people who are investing in you are going to want to see you succeed. So they're going to tell you everything they want to see from the product or project, or when your marketing or your packaging is not resonating. And then the internet being what it is, the rest of them are just going to call the spade a spade. Or may call you worse, but that's the beauty of trolling. Now, on the downside, crowdfunding does come with some hang-ups as well. There's tremendous need for constant upkeep and promotions. When you launch a campaign, it's not as simple as going live on day one and expecting that it's going to take off. So if you think about it like a heart rate monitor, you're going to have points in your campaign, if it lasts 4 weeks, 6 weeks, 8 weeks, where you're going to hear crickets chirp. Instead of spiking, you're going to have plateaus. If you think about that heart rate, there are going to be signs of life, and other times it's going to be looking like it flatlines. So you have to think to yourself, how am I going to keep people talking about this? How am I going to keep word of mouth going strong throughout the entire duration? And of course, on the flip side, even if I can get it in front of people, how am I going to incentivize them to actually reach into their pocketbook and spend? And it's also best for easily illustrated projects. So on the reward-based side, especially, what we find is if you have something that's quickly communicable, very unique, stands out at a glance, it's very effective. You have to be singular. And you have to wonder, from a business perspective, if I have a customer relationship management software platform, an inventory management software platform, or I'm franchising restaurants, how sexy is it? How likely is it to catch their attention? Because discovery is a big challenge. So there's no stealth mode here. You've got a lot of products competing for attention. Consumer expectation is rising. We're seeing fatigue set in because there are only so many people who can donate and only so many projects you can be willing to be bombarded with ads for in any given week. And you have to be aware that it's highly public. So if you're not able to succeed, from a traditional investment perspective, it devalues the perceived worth of your product or brand. And of course, it siphons resources from your core business. Like I said, this can be a very intensive effort. It's going to take up a lot of your time. But the good news is it can be tremendously worth it because it helps you build leverage. If you can raise funds on your own, if you can prove out interest on your own, what Will and other guys like me on the angel investment side won't tell you traditionally is you don't necessarily want to take the money. What you want is the expertise. You want the contacts. You don't necessarily want all the strings attached. So this helps you negotiate better deals. If you can prove out that you have something that people want and that they're going to want en masse, and you're already doing it on your own and you've enabled yourself to create that business, to take it to market, that's very powerful. And of course, for our friends on the legal side, the impact of failure to be determined. We don't have a lot of historical precedent, so if you say, I'm going to ship a product with 20 features, and oh, by the way, you don't get the parts in that you need, things go over budget, ships late, you don't have as many features as promised, hard to say what's going to happen. So who is crowdfunding best for? And it is great for many different causes and many different products and concerns. It's definitely best for unique and visually compelling items. The law here is be singular, be arresting, be quickly communicable. This is the internet. You're going to have people's attention, and many of them are not going to be sophisticated traditional investors. You may have their attention for as little as 10 seconds. So you better be short, you better be succinct, and you better knock it out of the park. Now, the nice part about it is projects, products, anything that's got built-in IP or intellectual property or brand awareness, if you're bringing back a popular brand or you happen to have something, you happen to have somebody who's on your team who may have had a great successful track record, a filmmaker launching many projects, he's now doing a new short film that you're trying to raise funds for, that can be very powerful because you're trying to build trust. Again, these are speculative products and projects and businesses in many cases. So you need to make sure you've created that authenticity and anything you can do to rise above that din, because discoverability is one of the #1 challenges facing entrepreneurs and businesses today. And of course, it's great for low-cost ventures, and I say that relative to the industry. We see a lot of video game projects, for example, being funded in the $3 to $4 million range. Catch being, usually they cost about $30 or $40 million. So the more attainable your funding goal seems, the more likely people are to contribute to it. And of course, authentic brands or brand extensions, that's a big piece of it. So you're not going to see a lot of giants, I don't think, like Coca-Cola or Frito-Lay or Merck trying to raise funds, because one of the fundamental pieces when it comes to raising dollars from investors is convincing them that you actually need the money, that they're not guinea pigs, that they're not test subjects. If I've got $10 million in the bank, why would I need $1 million from you? How's that really going to move the needle? Or am I just mitigating risk? So there's an authenticity piece to it. And of course, mobilizing current communities. If you have a strong following, a lot of customers for your product, a lot of subscribers for your blog, then these are all people that you can activate and increase your chances of succeeding from day one because you have a captive audience. So Amanda Palmer, she brings up some great points. Now, Amanda was a major label musician, singer for the Dresden Dolls. And I had a chance to chat with her. She recently went independent and raised over $1 million on Kickstarter for a new album that she had, a new art book, a new tour. And she does it with a 3-minute video in which she doesn't utter a single word. All she does is hold up poster boards saying, "This is the future of music." And by the way, I'm going to let you decide which of these two beauties is Amanda. One on the right's kind of cute. But what I would say is that she has some useful tips here that businesses and brands can take away from it. And when we chatted, one of the points she brought up, as I was saying before, is that prior assets, experience, and brand or intellectual property equals power in the crowdfunding realm. There's a key visibility challenge. There's a lot of noise out there, and if crowdfunding is, in fact, a marketing-driven effort, you have to think about if thousands of other people are offering similar projects, products, or ideas, how am I going to stand out from the crowd? And having that built-in brand awareness can be very powerful. Of course, people buy results, not promises. So here we have a musician who's taken time to build up her following for well over a decade. She's got a built-in mailing list. She's got a product that people want. And people can empathize with her. They obviously like the video. But as she points out, it doesn't matter if they can empathize with her. That's just how she gets attention. That's how she creates a call to action. But ultimately what people are buying, what they're spending on, isn't Amanda Palmer's dream. They're buying the CD. They're buying the book. They're buying a concert ticket. V is not for vendetta. V is for value. That is the mandate. And you have to think about how you're going to incentivize your backers. At the end of the day, what's in it for them? That's the question to ask. And of course, building trust is essential because if you're doing the outreach, yes, you can show the financial statements. Yes, you can show cash in the bank. But if you don't have a massive track record, and a great track record is, of course, an important asset, ultimately what you're trying to do is convince people to part ways with their money and that you're going to be able to take it and pull off the vision as is stated. So you've got to convince them that you're the right project or team. Show, don't tell. Again, from an investor's perspective, sketches, concepts, drawings, everybody's got a great idea. Execution is what it comes down to. How many times have we thought, hey, I had that idea 5 years ago, fantastic idea for a product. The trick is the people who can pull it off, who can show working prototypes, who can show products in motion, they're going to do a lot better with crowdfunding than anybody who goes out there with a simple idea. And in fact, Kickstarter has banned it now, so you can't show 3D models or simulations. You've got to show the product or project as it exists. And understand the overheads and commitments involved. I'll just touch on this briefly. Like Amanda says, once upon a time she had a publisher and she felt they were sucking the life out of her. But the trade-off for going independent is that you don't have a team of people when posters are printed wrong or when FedEx ships late who can help you field that. So understand that if you do have 5,000, 10,000, 50,000 backers for any given venture, you're going to have to figure out how you're going to process reward fulfillment, equity fulfillment, investor relations. All of these are important pieces of the puzzle. So don't underestimate the overhead and time involved. Now, from an investment perspective, if next year we can start investing in crowd-funded startups and businesses, what do we need to know? Well, I'll tell you some big pieces. An obvious one is failure to deliver. Can the team, can the company, can they bring this project together as stated, and can they do it in the time frame as stated? Of course, another big one, creative control. Now, if you're buying into a project or a product or a startup, obviously you're buying into their idea. You want to believe that they have the ability to pull it off. But in a traditional investment scenario, like I was saying about leverage before, if I'm one of 5 people and you need the money that I'm contributing to make payroll that month, I can help exert a little bit of pressure if I feel the project's going off the rails. But if I'm one of 40,000 people who donate $100, if somebody takes this project in a completely different direction than I think it needs to be successful, that's a big question mark. Transparency and communication is a big piece of this. At the end of the day, if you're dealing with everyday people on the street, $100, $500, $1,000, that can be a big concern. They want to know where their money is. It's not like they're investing it and then forgetting about it. You got to keep them updated, got to keep them up to date on where the project sits, how far along in development it is, if things are going off the rails. And this is going to be very public, this exchange, by the way. You also have to worry about protection from loss or fraud. So how am I being ensured that my money is coming back to me and on the date as promised? I also have to worry about advertising and advice. I mean, let's face it, right? The rules and regulations are going to say one thing, but anywhere big dollars are involved, there's always going to be people trying to steer you towards an angle. As an investor, I also got to worry about equity dilution. Again, if I'm one of thousands of people, and what happens, it's not clear. What happens, can they go back and raise more financing, do another round? Can they later go on and talk to venture capitalists? I may think that I have a certain percentage of a company, but what happens at the end of the day if I wind up with less than I expected? And of course, there's the collection and recovery of funds. Now, having started businesses, I can tell you one of the hardest lessons I had to learn was for all the time you can spend lining up contracts and negotiating them, it all trickles downhill. And partners are going to interpret it whatever way they want to interpret it when things hit the fan. So if a vendor doesn't pay them on time, and you've told your investors, for example, if I tell you I'm going to give you $2 back for every one you put in by January 1st, the problem is if I don't get paid by my vendors, what's going to happen? Right? I'm not going to have money in the bank. So who's going to ensure that that's put together? And how am I going to distribute those funds and make sure everybody is taken care of? There's accounting liability, there's legal liability, and reality is a lot different than what you expect when you launch a startup. And of course, you have to worry from a long-term perspective. As we were saying, if we have to hold investments longer than ever, how am I going to divest myself of them at some point? It's not going to be a quick flip like a venture capitalist would typically be looking for. And on the other side, it's not going to be easy to quickly resell. So if your talking toilet takes the internet by storm, that's great, right? But if I decide I'm not in it for the long haul, a year later I want to sell the equity again, not quite sure how that's going to happen or how I'm going to convince you that it has greater worth than it did at the time when they initially launched it. So from the business's side, too, there's also the issue of partial or inadequate funding. So I'm going to set out with a funding target in mind. Some sites in the reward-based nature, if I reach 80%, 90%, will let me keep the money. And as a business owner, to me, that wouldn't be a failure, right? You never know, because there is a marketing and awareness piece to it. And if you get most of the way, it wouldn't seem like a bad thing. But to investors, it's going to seem like a failure, and it's going to devalue the perceived worth of your product or brand. And of course, loss of stealth and first mover advantage. So the second this thing goes live, you have to keep in mind that other competitors may be out there. They may accelerate their product, get it to market faster. They may change up their feature set based on what I'm offering to outclass me. And of course, there's the operation structure and cost involved with doing investor relations on a scale that's much larger than a small business might expect, maybe on par with what you would expect from a publicly traded national. And of course, there's the issue of communications and transparency needs. So publicly traded companies, I might find out every quarter how they're doing, how their sales are coming along, and when they launch new products regularly, I can see if the market's actually buying them. But this may not be the case if you're creating a single project and it's going to take 2 or 3 years to bring to market. And of course, I have to be worried about the public nature of the exchange and operations. When I disagree with my venture capitalists that are backing me, we may not see things eye to eye. But chances are they're probably not going to turn to Twitter and start airing out our grievances. So what happens if you've taken money from thousands of everyday people out there who may say, well, I just want to know what's going on, and they may instinctively react based on gut. And this can cause problems for any company or brand or public image, and again, the perceived worth of the associated properties. And of course, there's accounting concerns, legal concerns, advertising rules and regulations. Like I was saying, with the whole issue with social media and the public nature of conversations, you can't please everybody, right? At the end of the day, you're going to have thousands of backers, and you're never going to do it just right to make sure that they're all happy. So you have to do the best job you can, but there are going to be communications challenges out there. And of course, there's little historical precedent. You don't know if you can raise more money later, if you're only going to get one shot at this, if $1 million is the possible max, if you can then go back for another bite at the apple. And of course, it's not really transparent. What happens if I buy into a company that's got a great new product? I love the product. The only problem is they've got the rights to distribute it. They don't own the patents to the actual product itself. So what happens if this thing falls apart at the last minute? So you have to be concerned about that a little bit, and you have to do a lot of due diligence.